Now we get to pivot into Europe, which did record a double dip recession. I'll bet it was small. It wasn't a huge step down. And there's some pieces within that we just wanted to touch on and go through, just because there's some mixed readings throughout that different capacity. So let's just touch on France. So when we look at France, consumer spending started to roll over a bit in March. There's some of that has continued through a bit, but when we look at just kind of what does that mean in general, is like what is continued on. So we have CPI that increased, we had PPI that increased. So PPI, CPI, again, those inflationary pressures that are continuing to go through for April, which it's not going to stop consumer spending. It's just, again, going to kind of weigh on some of those pain points. So then when you look at GDP, France was one of the only ones that did record growth. It was up 0.4% quarter over quarter. But that PPI is the one that we're talking about when we look at month over month, that steady increase from 0.8% to 1%. Year over year, obviously, there's a big number jump from 4.5%. But the CPI is the one that we saw the biggest increase in terms of 0.7%, 0.2%. And then when we look at PMI. So let's shift a bit to PMI. So manufacturing PMI for April was expected to be at 59.2, came in at 58.9. Services was supposed to be at 50.4, came in at 50.3. So the composite was supposed to be at 51.7, came in at 51.6. So far we're starting off Q1 in an expansionary territory, but slower. And that's the biggest headwind, because the headwind remains services. And France is starting to open back up. We're starting to see some of the movements. We're starting to get, what is the election going to look like? Where is Macron going to be versus Le Pen? These are some of those friction points that, again, elections just provide uncertainty. Consumers do less with uncertainty. And that's why when we look at PMI, services will continue to be those overhang. Both expansionary, small and expansionary. So again, it's going to keep pace with this 0.4%, and we'd like to see this accelerate. It's just when we look at Europe, we're not seeing all of that much acceleration specifically in the continent, and that's where we start to get a bit concerned on what comes next in general. So then when we shift gears a bit, and let's now look at what's happening with global trade, because some of the things that we always talk about is what is going to leverage GDP the most. And we talked about Germany last time, where Germany is levered more and more to the global trade market, with Korea I think really increasing that level. And it's only going to get bigger, especially as we have supply chains moving out of China, but people have been relying more and more on Germany. And we continue to see some of this pressure, especially when we look at PPI, where that pressure is going to get passed on to the consumer. And you can see China and India at the lower end, where China is actually less and less. Whereas, and as we said, I think it was about 2 months ago, we talked about how China's GDP leverage to exports is only 15%, or 15 to 16%. So to stimulate or at least to undercut or provide some sort of subsidy to support exports doesn't make a whole lot of sense, especially when you're looking to stimulate domestic consumption. So that's where when we look, the leverage is going further into Germany. So now that we've talked about that, let's look at Germany on an aggregate side. So when we look at CPI, we have inflation moving higher month over month, year over year, not surprised. And GDP, so this is where the negative GDP growth came in, where we had GDP coming from the Germany at negative 1.7%, depending on the metrics that we look at. But again, this is the double dip, and this was enough to pull down the Eurozone aggregate, because obviously Germany is a bigger part of that pie. So that's going to pull it down the most. So then when we think about, we've talked about that, let's now look at PMI. This is the concerning side of what comes next. So manufacturing was supposed to be at 66.4, came in at 66.2. Great, like that is a good number. Not saying that is a bad number at all. The issue is on the services side again. So the services was supposed to be at 50.1, came in at 49.9. So even though we have manufacturing being a big driver, which speaks to the GDP side, so GDP exports are a big part of it. That remains. That's going to stay strong, but local consumption is still struggles, and the trend is negative. And that's the concern, because then when you look at the composite, obviously because manufacturing matters more, the composite was expected to be at 56, came in at 55.8. It's just the services headwind is going to be there as we see the manufacturing starting to roll. And when we say roll, again, it's relative. Just as we talk about with the US, some of the components getting it to 66 are a negative make it a positive number, but are negatively will impact things on a negative level on an economic base. When we look at inventories and cost, as we continue to see a marked shift higher in inflation throughout the supply chain, making their prices just higher in general. So then when we think about the input shortages, and that's why we want to look at the input shortages in general, and they've risen across the units in general. So when we look at April versus January, you can see that the hope was things were going to get better, especially as we got into January, because if you remember, I was saying, a couple of weeks ago that typically March and April are slow periods. And that's usually a time when you get just some movements, some adjustments. Even during that period, we made no real progress. Instead, things only got worse in April, not better. And it's just compounding on itself, because this doesn't just clear. Like, you can't just open up another port. You can't just open up another slip. You need specific structures. And now that's why without a lull period or this big aggressive push, we're just not able to close that gap, which is creating this additional struggle, this additional strife within the system. And that's why when we look at GDP and the importance of exports to Germany, this is going to become a big overhang. Now, retail sales were up month over month in March. It's just, expectation was 3%, came in at 7.7%. But the services is telling me it's going to come down, because last month, if you remember in March, services beat to the upside. And now it's beating to the downside, which speaks negatively for where retail sales are going to go. And if you look at Oktoberfest, that has been canceled. So again, these are some of those friction points that will remain in the system. So then when we look at Germany's supply chain as an aggregate, manufacturing companies in Germany reporting shortages of intermediate goods is approaching 50%. This is going to create more price increases, more shutdowns of manufacturing. And again, that's going to be the biggest hit to the German GDP. So then when we look at the Eurozone GDP, the survey was for 0.8%. The actual was negative 0.6%, slightly better. And it was driven by, there was some growth or some things coming in a little bit better than expected, which was a net positive. It's just Germany, the biggest, behemoth in the system, still came in well below where expectations were. And the Euro area GDP, 6% below the pre-crisis level. And this is with all of the stimulus that we've seen. This is with the rejuvenation and movement of shifts away from different supply chains. We're just not seeing the same type of growth or recovery in Europe as we are in other parts of the world, which is why I still remain very concerned over GDP estimates in the market for Europe, as well as parts of Asia, more specifically India and China. And then when we look at just the inflation, the contributions to the region is energy. Now, food is going to remain there. That's going to become a bigger problem. Services, as some of these services come back, or in some of the reopening, but energy is not going away. I mean, we currently have Brent at 68.72, so we're not going to see this stop. And especially this is factoring in without much of a reopening. So now as the reopening accelerates, you're going to see some of this pressure, and that's why it's going to continue to drift higher. All the while, PEPP purchases are shifting up. So the pace has accelerated. And if you remember at the ECB meeting, they said they were going to see an accelerated pace of buying. And here is it coming. And this is that adjustment that we've seen in terms of the rate of change. So coming from Fred, you can see his Twitter status, right there. I recommend you follow him. The ECB's PEPP officially hit the 1 trillion mark last week. At the current, slightly more significant pace, the 1.85 billion envelope would be exhausted by March 2022, which again is kind of that hope where it provides the support to kind of follow through and see some of this growth well into 2022. And this is just looking at it from a different perspective as to when that ECB meeting happened, when we were going to see that acceleration. And you can see that's when we got that pivot pitch higher, pace higher. And it's just that now when we look at Italy and we look at the pace of activity on the stimulus side, it's only accelerating. But the problem on the accelerating side, so when we think about Italy on a PMI level, and this is the fun side. So manufacturing PMI came in, was expected at 61, came in at 60.7, positive. Services PMI was expected at 50, came in at 47.3. Now, they are more levered to services, with the Italy composite coming in expected at 53, coming at 51.2. The slowdown is the biggest problem, and it's happening at the consumer level, which is why we remain concerned on just how quickly we can get some of this movement. And that's why a lot of the stimulus is continuing to move through. So the ECB has ramped up their net purchases under pandemic purchasing program. PEPP holdings increased by 80 billion in April, euro in April from 73.5 in March, and most since July. In February, ECB had decided to significantly increase volumes, which was the biggest driver for things going forward. And that's why when we look at what comes next, the inflation is going up, consumer is slowing, and manufacturing is starting to peak as you're getting that residual issue in the system when we're looking at health of manufacturing. And that's why the European double dip, that move down, it'll get positive again, but it's not going to be where it should be because the consumer just isn't there, and manufacturing headwinds are accelerating, not decelerating. And that inflation is going to be that underlying pressure, which again is going to be a headwind for future growth. Now that we talked about Europe, especially the big two, we want to pivot into Asia and emerging markets because, again, the problems continue to arise in different ways, especially in this market, because that's where we see some of the biggest overhangs for growth and recovery. It really is within the Asian markets.